I'm Fred Thompson, and I'm inside business.
In the midst of the worst economic crisis since the Great Depression, many villains have been identified, one of which experts say has been the massive and unregulated use of over-the-counter, or OTC, derivatives. But for thousands of companies, like global real estate corporations, Simon Property Group, and Host Hotels and Resorts, along with healthcare services company, Hospital Corporation of America, certain types of derivatives play a critical role in helping them mitigate risk. So the question prevails, are these financial instruments, known as derivatives, misunderstood? Industry experts believe so.
Well, a derivative, in the most basic sense, is a financial instrument or contract whose value is derived from the value of something else. Now, there's essentially two purposes for OTC derivatives. They can be used as a tool to mitigate or reduce risk, or they can be used as a trading instrument. Now, because most OTC derivatives are all lumped into the same category, there's often confusion around whether they're destructive or whether they're beneficial.
The U.S. OTC derivatives market was established over 30 years ago as a risk mitigation tool to enable companies to more easily offset cash flow volatility stemming from interest rate and currency risk. But in the late 1980s and through the 1990s, traders and investment managers began using derivatives on other types of indices and more as trading instruments, which allowed them to move in and out of market positions very quickly and efficiently. It's this evolved use of derivatives as trading instruments that experts say has introduced more of the systemic risk and caused the negative connotation surrounding the financial instrument today.
In the current economic crisis, derivatives certainly have amplified the problems that we've faced, but that does not mean that all derivative usage is risky or bad. Derivatives are used in very different ways, and it's how they're used. It's not the instrument themselves that is the issue.
Experts at Chatham Financial say when used properly, derivatives play a key role in helping companies navigate several common capital market risks.
It's important that companies distinguish between using derivatives as a risk mitigation tool or as a trading instrument. Now, since Chatham only serves clients that are seeking to reduce the risk that they have, our focus is really on ensuring that they enter into appropriate derivatives, that they have fair contract terms, that they pay a fair price, and that we've guarded against future adverse events.
Thousands of businesses in a wide range of industries use interest rate and foreign currency derivatives every day to manage their risks.
One common way that firms will use interest rate derivatives is to hedge their risk on floating rate debt issuances. Oftentimes, a company will issue floating rate debt to make investments in their own businesses, but it leaves them at risk to rising interest rates. Many times, those companies will take out an interest rate swap contract to effectively fix the cost of their debt, thereby removing any risk to rising interest rates. Companies will often use foreign currency derivatives to limit their exposure on purchases that they may make overseas of equipment or raw materials. If the US dollar depreciates significantly, the purchase of that equipment may significantly impact their budget. As a result, companies will often use foreign exchange forwards or options in order to make known or limit their worst case cost of this equipment or raw materials.
To best leverage interest rate and foreign currency derivatives, it's important for a company to be well educated on these tools.
For a company to best leverage interest rate and currency derivatives, it needs experience and up-to-date knowledge of the changing marketplace. It needs a proven process to ensure that it gets fair pricing and a strong accounting function and systems to manage the valuations and reporting throughout the life of the hedge.
It's through the proper level of expertise and thoughtful application of derivatives for risk mitigation that companies like Simon Property Group, Host Hotels and Resorts, and Healthcare Corporation of America are effectively equipped to manage these risks and optimize their business opportunities.